Welcome to this video on Chapter 4, Limited Companies and Multinationals, part of the Edexcel IGCSE business curriculum. In this video, we will explore the differences between business structures, examine how they function, and analyze the implications of operating as a multinational company. A limited company is an incorporated business, meaning it has a separate legal identity from its owners. This grants shareholders limited liability, meaning they can only lose their initial investment, and allows the company to own property and be involved in legal proceedings. To form a limited company, you must draft a memorandum of association covering business details and share issuance, and articles of association, which outline internal rules. Upon approval, you receive a certificate of incorporation to begin trading. Private limited companies, or limited companies, are typically small to medium-sized. Their shares cannot be publicly traded and are instead transferred privately. Often, the directors are the shareholders, which helps them maintain control. The key advantages of a private limited company include limited liability for its owners and the ability to raise more capital than a sole trader. However, drawbacks include the requirement to make financial information public and the cost and time associated with setup. Public limited companies, or PLCs, are larger organizations where shares are sold publicly on the stock exchange. Establishing a PLC requires a minimum share capital of £50,000, and going public involves significant costs related to printing, legal fees, and underwriting. PLCs enjoy several advantages, such as the ability to raise massive amounts of capital from the public, achieving economies of scale, high liquidity for shareholders, and increased publicity and status. However, PLCs also face disadvantages, including the risk of hostile takeovers, exposure to public scrutiny, a potential gap between ownership and control, and strict regulatory compliance requirements. A multinational corporation is a business with significant operations in at least 2 countries. Well-known examples include McDonald's, Microsoft, and Toyota. Multinationals are defined by several key features: huge assets and turnover, the use of advanced technology to maintain efficiency, global marketing strategies, and the realization of economies of scale. Businesses become multinationals to increase their market share, lower operational costs through cheaper labor or raw materials, bypass trade barriers, and access government grants or funding. The host countries where multinationals operate often benefit from new jobs, increased tax revenue, the transfer of technology and skills, and improved balance of payments through exports. Take Hyundai Motor Company as a case study. By maintaining multinational status, they gain global scale and manufacture vehicles across various countries, which keeps them close to their target markets and helps them avoid high transportation costs. To summarize, the scale of a business often correlates with its structure, from small sole traders and limited companies to the very large-scale operations of public limited companies and multinationals. If you have any questions regarding the topics covered in this video, please feel free to reach out to me, your teacher, Yan Nangtun. You can contact me via the email address or phone number shown on the screen. Thank you for watching. For more educational content on business studies, you can visit my YouTube channel, Bees Knowledge by Kendrick. Don't forget to subscribe for future updates.